Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. The question we're asking today, short-term underperformance in the Nasdaq-100, a longer-term issue. Joining me to discuss is Steve Sosnick, Chief Strategist at Interactive Brokers. Steve, it's great to see you. Happy New Year. Welcome back to Trade Talks.
Same to you, Jill. Great to see you. Happy New Year.
All right, thank you. And the Nasdaq-100 has been underperforming the S&P 500 recently. What do you attribute this to?
Well, the simple answer would be people are getting a bit nervous about the relationship between the NDX and the 10-year. The logic here being that these stocks that are, very, very highly valued for their excellent cash flows and earnings, as you raise the interest rates level in the market, particularly on the longer end, you start to discount the future cash flows by a bigger number, which shrinks the present value of them. That would, in theory, shrink the present value of the leading stocks in NDX. And I think that's sort of the nervousness. The question becomes, is this permanent? Are people really continually worried about this? The last time we had the spike up in interest rates was March of last year. And while the Nasdaq, had a bit of a stumble, it didn't really fall out of bed by any means. And really, for 2021, NDX and SPX moved roughly in lockstep, whereas in 2020, because people wanted to pay a big premium for the earnings stability and earnings foreseeability of the leading tech stocks, NASDAQ outperformed dramatically. So I wouldn't read too much into it. The two, over the last year, the two have sort of moved up and down, intertwined, and we'll see how long this persists.
Right, because of the exposure that they have to technology in both of the indexes. So let's talk about term structure a bit here and what you're looking at with Nasdaq 100 and QQQ term structure. Does it indicate any nervousness in there?
Not yet. We definitely have seen volatilities rise across the complex, but not anywhere close to even where they were a month ago. Think back to like early December, volatilities were much higher across the board. And we saw some inversions where the shorter term volatility, implied volatilities were higher than the longer term implied volatilities. That's a sign of, I'm going to call it a shortage of available volatility protection. That's not what we're seeing now. We're seeing still sort of a more normal curve where shorter term vols are lower than longer term vols. And I will also say that the vol level overall is not even where it was a month ago. So I would say, even though we're seeing some pullbacks here, we've basically just given back a bit more than the Santa Claus rally, which was really just, a seasonal rally on light volume. And I don't see the big signs of nervousness in the market. Glass half full would be, see, people aren't panicking. Glass half empty, of course, is, are people complacent? And that leaves more downside. We'll know over the couple of days ahead. And I think you should, people can position based on whether they're on that interpretation.
Right. And I know that you're also taking a look at the spread between VXN and Vol Q. That's also signaling some relative calm.
It is. As we've discussed before, Vol Q is a very good measure of the at-money volatilities in the NASDAQ complex, whereas VXN, basically has all the wings, all the puts, basically anything with a positive bid. And if we were seeing real nervousness, we would expect to see VXN rise faster than we'd see Vol Q. The spread between the two would widen. We're not seeing that. We're basically seeing volatilities go up a bit, but only marginally, and we're not really seeing that rush to put protection that one might expect. That's another sign of relative calm, sure.
Yeah, well, it's so interesting when you think about it from a fundamental perspective, and it makes total sense. I mean, we saw this massive run up in tech stocks. People were willing to pay that premium. Then we know interest rate hikes are coming. You have to think about valuations at some point. So while the fundamentals might still be there, just valuation and rates really seem to be big headwinds for the tech space.
Yeah, I mean, you can ask the question, why are they headwinds now when they really haven't been headwinds before? And I mean that in a good way, because again, people were really willing to pay the premium for the certainty, or at least the perceived certainty of earnings and cash flow that you get in the biggest tech companies. It's natural to sort of see a little bit of a pullback in that enthusiasm, particularly as you start to see rotation into other sectors. And one thing that does hamper NDX relative to SPX is NDX explicitly excludes financial stocks, which have been good performers, and the energy weighting is essentially nil, which has also been helping SPX. So you know, it's benefited when there was this huge rush to tech stocks. It's underperforming now that tech stocks are a little less out of favor. But it's a long way to say that there's a rush to the exits right now in tech. There's just been what I would call a pullback so far.
All right, Steve, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.